Hi, Tom Lydon here in Chicago at the Charles Schwab Impact Conference here with Dave Mazza, who's head of ETF Investment Strategy for OppenheimerFunds. Dave, great seeing you.
Tom, thanks for having me.
We had Sharon French here earlier.
That's right.
Talking about your new launch of single factor, multi-factor ETFs. Let's take it a step further, and a lot of people are wondering, with all the choices that are out there today, how do you actually use these tools within portfolio construction?
Well, I think you're spot on. There's been a lot of product proliferation in the smart beta space for good reason, because they're really outcome-oriented strategies.
Yeah.
Let's think about single factor. Those are precision tools that investors can use to get access to value stocks or get access to small size stocks in a rules-based way. And I think about those as a way to complement existing positions in your portfolio, whether they be active or passive, or for advisors to create their own strategies around, maybe using the macro environment or using other information. On the other hand, multi-factor, that's a great way to be a core holding for advisors.
Yeah, so on the single factor, and you talk about the macro environment and what's going on, you have 6 individual factor strategies. Based on, again, not looking for predictions, but where we are within this economic cycle right now, what are advisors selecting within those factors that they may overweight, and what might they underweight as we go into 2018?
So what's been interesting is if we think about the environment we've been in 2017, we've actually been shifting from times of expansion to times of slowdown.
Yeah.
That's when it's kind of been a unique environment. But if I look at performance this year, quality stocks, the quality factor index, has vastly outperformed other factors and the broader market for good reason. Investors still want to be in the equity market, but they're looking to say, I want stocks that actually have higher return on equities, improved balance sheets to help maybe weather the storm if they're a little bit scared of what the future looks like. So we are seeing quality really outperform other factors this year.
Gotcha, okay. And then when we get to multi-strategy, would you say for the average advisor who enjoys seeing that there are different factors, but they don't really have the ability to make those decisions, they may not have the research, and they can trust Oppenheimer because you're living and breathing it all the time to make those calls?
Yeah, so here's what's interesting. So when we launched OMFL and OMFS, it's to take advantage of that principle you noted just there, is that we can look at the data and know diversifying factors, even naively, can benefit investors.
Yeah.
But really the power comes from the fact that based off of the economic regime that you are in or moving into, you actually want to be in different factors. So in recovery, you want to be in value and size. In times of contraction, you want to be in quality and low volatility. So as opposed to an advisor trying to say, I got to pick which one might work over the next 6 months, this actually can help do that for you. Still give you the exposure to the benefits of factors, but do so in a prescriptive way that's adaptive to today's ever-changing macroeconomic and market environment.
And when you, let's say, have a variety of multi-active managers, this might be a nice, steady overlay.
Yeah, so here's the way to think about it is, let's say I have a preference for active management. I've been selecting active managers for years. I like to have the ability to outperform a benchmark. This strategy can still do so, but for OMFL, the large cap, it's 29 basis points. For OMFS, it's 39 basis points.
Yeah.
So you still get the benefits that active managers have used, but you do so in a rules-based way at a very attractive, cost-effective, tax-efficient price point.
Which is really important. Dave, as always, love seeing you.
Yeah.
Thanks so much.
Thanks for having me, Tom.